Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He's a former research analyst at Stansberry Research, and now he's the editor-in-chief of Palisade Research. They have a popular YouTube channel. I believe they're out of Vancouver. They cover a lot about natural resources, commodities, global macro. Adem Tumerkans, thank you for joining me.
Great. Thanks for having me, Jason.
And I think I got the pronunciation right there, too, without any other tries.
Yeah, you did. You got it great.
Okay, Adem. So what's your opinion on the global economy with your macro analysis? I know you look at Austrian School of Economics, and you're telling me beforehand that you also study Minsky. So what's your view about all the crazy stuff that the central banks have done in the last 10 years since Lehman Brothers?
Yeah, so over the last 10 years with the central banks, especially with the Fed, Bank of Japan, and ECB, we've seen them pump. They basically have doubled down on everything that caused 2008 and every crisis before that. But that shouldn't really come as a surprise anymore to anyone because that's all these central banks can do. And I'm sure like Minsky has written about liquidity traps, that they can increase the money base, but they can't force people to borrow. And after 2008, we've seen central banks do whatever they can to protect the big banks, protect the hedge funds, and they cranked rates down to zero. They printed $4+ trillion, just the Fed alone, and that money didn't come into Main Street. Everybody, there's a theory by Richard Koo called a balance sheet recession. And it's a good description of what's happened to Japan over the last 30 years and why they can't get out of like that just low growth, low interest rates, even though the BOJ is printing money and stimulating like crazy. It's that when people are focused on deleveraging, they're not focusing on profit maximization. So if somebody's already under debt so much, you've heard the term like zombie banks and everything, of course. All these big banks and companies, they're just refinancing at lower rates, trying to skate by enough so that until the inevitable default hits, like we saw with Toys R Us or Radio Shack, the big names, they're able to just refinance lower and lower. But now that we're seeing the central banks over, after all that easing and rate cuts and trying to stimulate, 10 years later, they're raising rates. Well, in 2015, the Fed started in December. But you have all these people locked in or refinanced already. Like I live in Scottsdale, Arizona, and a lot of people, it was a refinance bubble. And it was everybody, working at Quicken Loans and all these lending institutions. They were refinancing their debts lower and lower and lower, taking out that money, going out and spending it on, especially auto loans. Out here in Arizona, I've never seen so many luxury cars in a Walmart parking lot. That could be like its own indicator, like the luxury car Walmart parking lot indicator. Like there's Maybachs, there's Lamborghinis, just in an actual Walmart or a Food City parking lot. So all these people keep refinancing their debt lower and lower. Now they're locked in, and now they're starting to raise rates. Well, when rates go up, like Minsky says, they start. Same with Mises in the Austrian school. Asset prices start falling, or at least they will stop increasing. And when they stop increasing, asset prices, speculators come in. They're the ones that get out of the top. Then algorithms selling, everything kind of snowballs down. Asset prices start falling lower and lower. And then mom and dad are stuck with a house that they refinance. Now that's like 30% under the equity. And when your equity is down 30% and you've already refinanced, but the Fed's raising rates, you can't refinance at a higher rate. That would make no sense. And two, you wouldn't even be able to because your house is 30% underwater now. So, just looking at everything, how it's been playing out, especially this last year, I don't see the global economy getting out of this. I see the Fed, they're going to have to, I think they're in a race against time. They're just trying to hike what they can, but they're hoping they can do it enough before the next recession kicks.
Plus, Adem, most people have not gotten a raise. They haven't gotten a boost in their income in order to pay off higher debt. So they've I've talked about this in a shorter period of time. You can use the credit card maybe to buy yourself time, but if you're not boosting your income, you don't pay off the debt quickly, you're going to be in a lot of trouble. And
Exactly.
so like whether it's the central banks, whether it's the governments, whether it's even corporate debt has more than doubled globally since the 2008 financial crisis. Lessons were not learned.
No, none were. The reckless lessons were learned, like the moral hazard, the toxic malinvestment was learned, that everyone can continue. You can punish the savers and the prudent and reward the speculators and the risk takers, not even them. I'm sorry. You're rewarding the stupid and the ones that, bankrupted themselves. You're just giving them a second chance.
Yeah, and I think the other thing in the U.S. is that we're starting to see, even in the Federal Reserve's own data, is that inflation is picking up, and we're hearing some people inside the Federal Reserve admit that inflation is a lot higher than their 2% target. But you mentioned Minsky. I haven't read a bunch of Minsky. I did read his 10-page financial instability hypothesis, and one of the most important things, and I totally disagree with Minsky because I am a free market Austrian school economic believer, is that he said that central banks provide stability. Mm-hmm. And so that I would turn that around on what he said and just say that they only provide an illusion of stability. So, they could claim that for the last 10 years, we've had a recovery, right? And yeah, if you owned asset prices, if you own stocks, bonds, real estate, the last 10 years, things are good for you. But if you didn't have that type of asset, if your income didn't go up, then, this recovery that they're claiming, the central banks, doing all of this QE and unprecedented monetary policy, then it hasn't created any stability.
Yes, no, it hasn't. With Minsky, I like his financial instability hypothesis. I think that's the best thing he's brought. But I agree with you. He is still a Keynesian. I think he actually have a lot in common with Friedrich F.A. Hayek, but at the same time, he does think that the government has to come in and take regulation at times. So I agree with you on that. We got to take the real rule to take from the financial instability hypothesis is that periods of low volatility and risk aversion are the seeds for future high volatility and chaos. So when people feel they're safer and they're calm, they're driven by their short-term memories and they think, hey, everything's been good lately. I think it's going to keep getting good. So everybody gets more risky, but that added risk taking piles up like an upside down pyramid. And whether it's an external factor like the Fed raising rates, that's definitely one that could tip the pyramid over. Or another one would be like an internal problem is that defaults inevitably start rising. All these, tip the pyramid over, and next thing you know, everything shatters.
Yeah, and people are getting too complacent. Like, for example, in the global macro picture, you're seeing people in Canada that are taking out home equity lines of credit, second mortgages, because they don't think their home prices are going to drop 20, 30, 40%. Australia, now you're starting to see their housing bubble start to collapse. So there are signs of complacency. We saw this. I study financial history a lot. I don't know about you, Adam, but Irving Fisher, prior to the October 1929 crash, I think he was within a month. He was a little early. He said that stocks have reached a permanently high plateau. Now, I don't know if we've had anyone recently quite have the hubris that Irving Fisher did back then, but we're seeing, similar signs of that the economy is ripping. That's why we can raise interest rates, that, things along those lines, that things are so bullish. That's why we can raise interest rates. But what I see, though, for the global economic picture is, okay, maybe certain things in the U.S. economy can handle slightly higher interest rates, but those rate hikes eventually at some point, maybe it's not for the rest of this year in 2018, maybe it's sometime in 2019. But if the Fed keeps hiking rates, eventually something is so leveraged, like you said earlier in the interview, I don't know what it's going to break, but it's going to break something because everything is so over leveraged. So maybe it's going to break corporate bonds. Maybe it's going to break an emerging market government or an emerging market bank or a European bank that loaned out too much money to an emerging market country or an emerging market corporation or an emerging market bank. So there's just so much risk in the system that I don't think any of the stock market or bond markets are really pricing in right now.
There was Yeah, I agree. I'm a big financial history buff as well, and I'm sure I don't know if you ever knew, but in 19, I think it was 1982. It was when Mexico, right before they first defaulted, they were about to default, and Paul Volcker told that, I mean, the world was about to collapse because of this Mexican default. And Paul Volcker told the private banks to keep lending to, Mexico, like the Mexican banks, to keep them afloat because they knew how bad it would be if they defaulted. And a lot of people, so it was a big crisis was averted, but a lot of people don't know about how many times these central bankers have gotten together just kicking the can down the road constantly. And I think that's exactly what we're seeing today. And the QT and everything, because, they're not even really unwinding the balance sheet. It's more that they're just not kicking back the interest and they're letting bonds mature and roll off the balance sheet. It's not like they're actually going onto the market and selling a lot of these bonds. So the day that happens, I don't see how someone like a JP Morgan, all them saying the biggest buyer and biggest holder of bonds is suddenly selling them now. Why would they hold on to them? Why wouldn't you be the first one out the door ahead of the wave?
Well, the funny thing, Adam, I don't know if you listened to the Victor Sprondio interview yet from a couple weeks ago, is he actually said the large U.S. banks went to the Federal Reserve and got the rules changed, and they have a separate new account now that they can stuff U.S. Treasuries in. They can buy as much as they want in this separate account, and they don't have to write off any of the losses. So they can buy Treasuries at any price, even if they massively lose money on it, and they can hold it and not mark it to market, and they can keep using that as collateral for whatever bets they want to do, whatever loans, whatever crazy financial engineering or speculative bets in derivatives markets that they want to do. So I think they've already kind of changed the rules in preparation for another crisis in case, China or Russia dumps all their treasuries. Russia has already dumped most of their treasuries. China can't really dump everything, though, because I've talked about this. When they run a dollar peg, they have to have dollar exposure.
Of course, yeah. I agree with you.
So until China says, you know what, we're not going to run a dollar peg anymore, they still are tied at least somewhat to the dollar. Plus, they have so much, customers here in the U.S.
Something that's been really interesting. Have you noticed how the Chinese yuan has been tracking the price of gold more than any other currency?
Yeah, I've heard a lot of people talking about that. I haven't really paid much attention to it. I mean, there's a lot of private citizens in China that buy a lot of gold, and the Chinese government has been subsidizing all the gold production inside the country of China, even though it's not economic, and the Chinese government buys it. They don't let any of it hit the open market.
Mm-hmm. Yeah, I think they're the largest producer of gold in the world.
Yeah, but it's not because they have the best geology. It's because they've literally pulled all the gold that was underground forward. And I've heard estimates that some of their gold is so economic that it costs them that if it was an actual market price, it would cost them over $2,000 an ounce to produce it. So it's not economic.
No, it's all those gold they're mining, like you said, it's not being exported. It's going straight into their banks.
Yep. And that's how they prevent the gold price from moving too much, because they want to keep accumulating lots of physical gold. We don't know the real number. I have a lot of friends in the gold community. They think that the Chinese government has way over 20,000 tons of physical gold. I don't know if we're ever going to know the truth about that, though.
Yeah, that's true. I mean, it's simple game theory at that point. Why would you put all your cards on the table? It reminds me of like all the CIA analysts. They were saying for so long that, North Korea, they're not going to get a nuke. They can't get one. We see nothing on our satellites, and it kind of makes you wonder. Do you honestly think they put all their cards out on the table for you to see? And now all of a sudden they have to retrack everything and say, actually, never mind. North Korea actually does have better capabilities than we thought. I think it's going to be the same thing with gold. The market's going to, I don't think we'll ever know exactly how much they have. I don't think we'll ever know exactly how much the Fed has, but it is a lot more than they've, openly said they do. I think Russia, the same thing. You've seen massive buying in the emerging markets led by China and Russia and Turkey over the last, since 2008 in gold. So, I mean, it's got to be coming from somewhere more than just the mining. Not to mention, it looks like we hit peak gold production in 2016. Now we're starting to see that the gold, like Barrick's having less gold production. I'm not one of those people that's going to say we're running out of gold on the earth, but at $1,300 gold, I do think we've hit all the big deposits we can. So unless we see gold at 2,000, it just isn't economical going forward with those.
Yeah, I agree. It's a function of price. So the people who are saying peak gold, it's kind of a misnomer. It's a function of price. So if the gold price is at 1,200 or a little above 1,200 when we're recording this on Friday, October 19th, 2018, the gold price has had a rally along. The dollar rally has continued against emerging market currencies, against G7 currencies, and the gold has started to rally again because I guess money is starting to rotate maybe out of stocks. People are starting to get worried. I did a live stream yesterday about institutional investors were getting very, very worried about all this volatility and other reasons. So they're starting to sell stocks now on rallies. But the gold price, I just remembered the point I wanted to make. One more point. So you mentioned CIA analysts. So I think people have to be careful about CIA analysts just because they have paper degrees. They made a lot of bad predictions over the years at the CIA, even though they have their Ivy League degrees. There was tons of people inside the CIA with 3 or 4 degrees, PhDs, supposed experts, and they were saying how the Soviet Union was going to win the Cold War just because the Soviet Union was spending more money of their GDP on military and defense. So be careful about the moral of the story is be careful about government economic data and be careful about government bureaucrats, even with all these credentials and all these paper degrees from Ivy League schools making predictions.
Definitely. It's like what Nassim Taleb, one of my favorite thinkers, has said. It's the intelligent yet idiot, the IYI.
Yes.
It's like just because somebody has, a huge degree in, mathematics, it's like we have this weird intuition, especially with government. Like when we're children, we think, oh, that person is a police officer, therefore they must be a good person. One thing I learned early on is your profession does not dictate the person you are. So when we see people, these economists and these smart, these politicians, we think that they're thinking for our best interests, but they could be very terrible people doing very shady things. And we see it time and time again. Like those 2 bankers just got caught rigging LIBOR. They got, sentenced for rigging LIBOR. That happened like a few years ago. It's just, 2008, big example too, with all the garbage loans, they were shuffling, like hot potato off of their balance sheet onto somebody else's.
And I think those 2 guys who pled guilty to rigging LIBOR, there's no way they were alone. Those guys were scapegoats. Those guys were fall guys. Those guys were patsies. They're the financial. I said this on the live stream yesterday. They're the financial equivalent of Lee Harvey Oswald, man.
Yeah, no, I agree. It's like how Solomon Brothers ended up. Remember John Gutfreund? They had those rogue trader. I think it was 1 or 2 of them.
Yeah.
They were like using money in the accounts from investors that didn't give them permission to use their money, and they were like buying treasuries and like using it as collateral to speculate. And they found out, John Gutfreund found out, and it was right when Warren Buffett was a big part of the company, a big shareholder. John Gutfreund found out like a year earlier, and they got caught doing this. John Gutfreund admitted, hey, I knew about it. Oh, he got exodus, he got banished out of the company. Warren Buffett had to step in to take control temporarily. And so I think since then, they almost lost their treasury license to auction treasuries. So, I think, like going forward, a lot of these top guys must know what they're doing, but they just can't admit it.
Yes, and a lot of I've lived outside of Washington, D.C. since the year 2000, except for going to college and temporarily law school. So I know a lot of the people in D.C. I've met people in different government agencies. I've heard stories, either firsthand, secondhand, thirdhand, from friends or acquaintances over the years. And there are some good people here who try to do good, but a lot of them get weeded out. So there's tons of Wesley Mouches here. There's a lot of people, unfortunately, that lie, cheat, and steal. Very, very unethical people. You were talking. There's tons of unethical people in the financial industry too. So there's, it's a dangerous, incestuous thing of unethical people in government and unethical people in the financial industry as well. There's lots of unethical people in both.
Oh yeah, absolutely. It's really scary once you get in there because you realize how many older people are putting their faith in these. And these people thinking they have their best intentions involved, and something like a Bernie Madoff, you would have never thought it. He was head of the NASDAQ, I think, or one of the big exchanges. Was it NASDAQ? Yeah.
Yes.
And
President.
Here he goes, president. Yeah, and then here he was the guy you would think would be the most ethical out of everyone, the guy who knew how to run things, and look what he did. He ripped off the entire world.
Well, I've studied that he actually had a boring broker dealer business, and as like the internet was coming on and people were switching to online brokerages, his business got destroyed. And so rather than trying to find a new business or reducing his standard of living, that's when he switched to the Ponzi scheme.
Oh, well, that makes sense. It just shows you how greed can really just ruin people and just the unintended consequences from it, which is exactly what we're seeing with the Fed today. Like, I always see, like, I miss the times where we saw like Ron Paul battling with the Fed. Like, you know what I mean? Like today, like they'll talk to Powell or Janet Yellen. They'll be like, hey, why do you think we're going to get growth, or why do you think raising rates won't slow down the economy? And then Yellen and Powell give some boring textbook answer, and then the congressman or whoever's asking them goes, okay. And then the next question, it's not like they follow up with it. Where in the days you'd see Ron Paul go, well, wait a minute, you just said this, but what if this happens? Or how do you know that's going to happen? You know what I mean? Like they don't do that anymore.
Exactly. Well, I mean, they're so busy trying to impeach Trump. They're so busy trying to get rid of Kavanaugh. They're so busy resisting, right? So they're too busy to ask important questions. They have to do all this other stuff.
Yeah, no, it's true. Like it's such short-sighted thinking. It really is incestuous.
Well, I don't think a lot of them don't have any common sense. I mean, Maxine Waters is calling for violence, and Cory Booker and some of these other Democrats are calling for violence now. But I don't know if I want to spend too much time talking about that. So,
yeah,
at the end of August, Adam, you put out an article called "These 4 Charts Show How World Trade Has Collapsed in Just 1 Year."
Mm-hmm.
So, do you think then that the problems are going to, with the global economy, the next financial crisis are going to start in China or emerging markets, like kind of how in 2006 and 7 subprime started to crack and break, and then it flooded into the rest of the housing market and then into the banks? Do you think that that's how things are going to transpire coming up?
It definitely could. But since May, there's this one indicator that I follow very closely. It's called the South Korean Export Growth Indicator. I call it SKEG. SKEG. And this thing has like a 30-year extremely accurate history of being a leading indicator, meaning that this thing moves first and the economic trends move after it. And 9 out of 10 times, 99 out of 100 times, I'm sorry, very close, mirrors the chart shows how the earnings for global corporations are going to be. All of a sudden in May 2018, this thing nosedived, and it literally dropped negative it was at a pretty good peak. And global earnings is still at that peak right behind it. So I started mirroring it and using like a Bayes theorem. I started, adding values to my, hypothesis, just saying, okay, like let's give it a 50-50 valuation. And I started looking at world trade. I'm like, what affects global corporate earnings? There's world trade volumes, the interest rates. And time after time since then, we've seen global trade falling, which is obviously going to hurt global corporations. We've seen the dollar get stronger, which is ruining these countries' balance sheets. And, I don't, and not to mention the higher interest rates are making it harder to get short-term dollar funding, as well as, on EBITDA, interest before earnings and everything. Like earnings are becoming diminished because of higher interest. It takes out of that. So I think by next year, that indicator is going to be prophetic again, and we're going to have a big global earnings miss probably by summer 2019. So I do think the trade and all these factors are playing into that bigger picture.
And the IMF and the IMF and the Bank of International Settlements, I believe, both of those two globalist organizations, they're already warning people that the global economy is slowing down a lot, that the earnings need to be marked down.
Yeah, they are now. So this indicator from May seems to be, pretty accurate, and I think it's going to be accurate again. I think we're going to have a big global earnings mishap, and when the earnings get whacked, I think a lot of these stocks and asset prices that people are overbidding today, they're going to have a wake up call, and they're going to have to revalue all their positions. And you could see like substantial, decreases on security prices.
So do you think then that commodities are going to benefit from this in this asset rotation? Because I talked about this on the live stream yesterday, that the institutions, they have large pools of capital. Some of these institutions are managing hundreds of billions or trillions of dollars, or pension funds. And so if they're starting to sell rallies on stocks, or anytime there's volatility, they're moving out of stocks, they're going to go into cash. Maybe they're going to go into gold. Maybe they'll buy some treasuries. Do you think commodities are going to be the beneficiary of some of this then?
Yes. So I think normally after an economy slows down, commodities don't do that well. And besides gold usually does well during tail risks or, black swan events. Besides like a 2008, which was, like you were saying earlier with Irving Fisher, what he calls dollar disease, when everybody's deleveraging, people had to sell their gold to raise cash. But then we saw gold rally as immediately after, 2009, once the floor didn't drop out from everything. So I think commodities are going to rally mainly because the governments aren't going to allow this crisis to roll over. They're going to keep printing. And when you keep printing, it's not really that I'm as bullish on commodities. It's more that I'm bearish on the dollar. So if the dollar falls in value, like last time, the dollar index, when they were doing QE, the dollar index dropped into the 70s. Right now, it's around mid 90s. So I think that once the Fed comes out and starts easing and printing, doing negative interest rates, you're going to see the dollar index fall significantly, which is going to push gold and all these commodities up in price.
Yeah, I'm not sure if all the commodities are going to do as well, but we were discussing this before we started recording, that there were some commodities with better supply demand fundamentals than others. So in your opinion then, what are some of the commodities with the best supply demand fundamentals that our listeners can go out and start researching now?
So I'm a big fan of gold. I'm also a big fan of silver, but silver is mainly a byproduct of other metals. So I think copper has really good supply demand fundamentals. Gold, uranium, but uranium's it's an energy metal. It's different than, copper. And copper is really dependent. It's like married to China, but we don't think China is going to end up, just rolling over. Like we're already seeing the yuan. They're already like secretly, covertly devaluing the yuan or letting it devalue. So I think we're going to see more fiscal infrastructure projects. Trump was trying to push his trillion plus spending, infrastructure spending bills. So yeah, I think copper, uranium, gold. Then you have like the special metals like cobalt, lithium. Those are good just because of the world's just shifting towards more of a greener, healthier environment. So those look good going forward. But yeah, those are kind of like the five I say have really good supply demand fundamentals. That like uranium, for instance, is doing really well this year, even during a rising dollar environment. Like when the dollar started rising this year, a lot of commodities got whacked with it. But we've seen uranium over the last few months doing very well.
Yeah, I wanted to bring up uranium because I know that on your podcast for Palisade Radio, you guys have uranium specials. I think you have a bunch of uranium articles out there. So when we were recording this, the uranium spot price is still around $27.40 a pound for uranium spot price. The largest producers in the world, like Cameco, Kazatomprom, Areva, those are like the three largest producers in the world. They've been cutting back on their supply. Cameco even turned into kind of a uranium hedge fund where they're going on the open market and
buying uranium.
Yes. Yeah, they were kind of doing an arbitrage, right? So they shut down their own production. They were going on spot market and buying and then selling it with their futures contracts that they had already.
So like what their platinum markets were doing, over the last few years. They're just going out and buying platinum and palladium on the open market because it's so much cheaper than producing it.
So uranium also was in a bear market since Fukushima. That was 2011. I had shares of Denison. I was up 4 times of that, and then I wake up and I hear about Fukushima, and I lost all my gains. So, so I remember that very vividly.
Mm-hmm. Yeah, I feel like you're investing in uranium is like the widowmaker trade. It's like no matter how many times we think this is it, it just keeps falling. But I do think this time is it because I think the best commodity bull markets are built off of supply destruction. Because a lot of analysts can overhype demand on the demand side, but when you see supply start diminishing and infrastructure on the supply side collapse, which we have in uranium, finally, like Cameco and them are finally throwing in the towel. They're shutting down their mines. Kazakhstan, the world's biggest producer of uranium, has done already two major. One was like 10% cut, and then they did a couple years ago. Then last year or January 2017, they did a 20% cut. I'll have to check my numbers, but they were steep cuts. And you're seeing global production is, I think since 2016, it peaked. Global uranium production peaked at some higher number, 160 million, like almost 200 million pounds of uranium was mined. But this year it's coming in well below that, like 20% below that. So we're actually finally seeing the supply side crumble for uranium. And to me, I think that is going to put the floor under the price. You see more uranium reactors coming online, and purchasing of uranium, and more, especially in China. And but you're actually seeing the uranium supply side start to justify like the foundations of a bull market.
And at the end of last year in 2017, earlier this year in 2018, I think Cameco got to as low as around $6 a share. And when we're recording this podcast, it's at $11.49 a share US. Mm-hmm. So it's already had a nice move up from the bottom there. If you bought it, you made pretty nice gains.
Yeah, I agree. Like with those kind of commodities, I personally like to buy the options. I'm a big fan of Nassim Taleb and Mark Spitznagel, their tail hedging strategies. And maybe 9 out of 10 times my positions won't work, but they're like high flyers, but they're so little that I won't get wounded over it. So I could lose 9 out of 10 times, it won't hurt me, but then that 1 out of 10 times, it's a home run, and it justifies all those other losses put together, then some. And I think using that strategy, I made a lot of money off the gold stocks at the end of 2015, and I loaded up on Cameco call options, and after their price shot up after it was in the sevens, the 1 year contracts were so cheap just for like the $14 strike price contracts. It just amazes me how the market they can be so short-sighted, not to mention, especially with option contracts, how inefficient the Black and Scholes modeling is. Like there's so many holes in that way of valuing options that, an intelligent investor, speculator can take advantage of it.
Exactly. There's enormous mispricings in the options market, but again, this is not financial advice. We're only giving our opinion. I have to give this stupid disclaimer after two suits with badges came to visit me and threatened to shut down my podcast and charge me for running an illegal. Yeah. I'm sure you heard about that. It was stupid.
Yeah.
But yeah, the with the options trading, I think the mistake that most people make is they don't have the knowledge like you do. So they don't know fundamentals, they don't know technicals. And what the pros that I know who have made a lot of money off options trading, they have all that other knowledge, and then they go and use the options for either like hedging or insurance, or they use it for leverage on their trade.
Yeah. No, yeah, I like you can run a good strategy. I don't know why people don't do this as much. Like if again, this isn't financial advice. This is something I would do. But like if you're going long, like you can, like for instance, I wrote an article at the beginning of August. It was the Buffett indicator is indicating that stocks have never been this expensive. And, this Buffett's favorite indicator, all that stuff, he's still going out and saying buy. So in the article, I argued, well, going forward, there's more little upside available. Once you're already at a high, it can't go that much higher. High prices demand higher prices. Eventually it'll top out. So why would you buy something when it's already at its highest, bloated, but then the risk is so much more, it can fall so much, a big height comes a big fall. So when you kind of look at these things, you could just, in your mind, look at something I like to use called asymmetry. And modern portfolio theory, they basically tell us that risk reward is symmetrical. So if you're going to, hold on 1 second, sorry, I gotta.
Oh, I'm not a fan of modern portfolio theory. Let's just put it that way.
Sorry about that. Can you say that one more time?
I'm just saying I'm not a fan of modern portfolio theory.
Oh yeah, no, it's garbage. And it's the thing is, these things work on the assumption that markets are perfectly competitive, and that the markets are efficient, but they're not. They're efficient 95% of the time, and then there's that 5% of the time you want to find and exploit.
And modern portfolio theory also says that you have to have a certain amount of stocks and bonds depending upon your age and your risk tolerance. So, and that it's basically like a cookie cutter model. So if you're a certain age, this is the portfolio that you should have.
Yeah, exactly. And you see a lot of millennials running out and doing stuff on Robinhood and everything, and it's
Robinhood's a fraud. Did you hear about that?
Yeah, I heard about it. You can tell me though again, but so everyone can hear. But it was bad.
Yeah, they just released in their filings, because I think they're going to go public soon, that they released in their filings that they're making tons of money off their customers selling the data to like the high frequency trading hedge funds, right? So
ripping off everybody.
Well, man, like we said earlier in the interview, that lots of people in the financial industry are unethical. So if you're not paying for something, if you're getting something that you think has value for free, it's probably not as good. What's the old saying? There's no such thing as a free lunch. Yeah. So if you're not paying for something that you think has value, like on Facebook, then you're the product.
Exactly. Yeah. So, I mean, no, I agree. And so like on the more modern portfolio theory, it tells you that risk and reward is symmetrical. So higher risk is high reward, low risk, higher, treasury bonds, you'll get little amount of money, but it's very low risk, or your private equity, it's higher risk, or, junk bonds, whatever, high risk, but it's higher reward. So you get the point. There are times, though, you can find asymmetric opportunities, and asymmetry is the opposite of symmetry. It's where you can find either high risk, low reward, which is what I call negative asymmetry, or positive asymmetry, where you have low risk, high reward. Low risk, high reward would have been like uranium for me, because even if I, bought at the low, I wouldn't have lost that much money if it kept going down when it was already at its bottom. But if things turned and went up violently like it did, you can make a significant amount of money compared to buying stocks when they're at their record highs. You know what I mean? And then little upside for huge losses. And, the thing is with this is that most people, that strategy will make money, 9 out of 10 years
over the long run.
Yeah. Like most people will be like, oh, okay, I'm just going to keep dollar cost averaging, buy, at record high prices, blah, blah, blah. It doesn't matter because in the long run, the market goes up. That's like fine. But what if that 1 year, like a 2008, that's the year you were going to retire? You know what I mean? And now all of a sudden your stocks get whacked. See, me personally, I'd rather lose, a bunch of little trades. Then blow my entire portfolio up. Like a perfect example was Victor Niederhofer in the 90s when he blew his entire hedge fund up selling options. And he did the same thing again when subprime blew up in 2008. And who was the one he was selling to? Nassim Taleb's hedge fund when he was operating it. And, Nassim Taleb lost money for a couple of years, made a cash load of money when long-term capital management and Victor Niederhofer's funds blew up.
Yeah, and if you're retiring in 2008, I guess you just had bad luck. So unless you knew the financial industry and you saw the train coming down the tracks and then you decided you were retiring anyway. Mm-hmm. But if you didn't know anything about the global economy, the banking system, the housing market, if you didn't know any of that stuff and you just decided you were going to retire in 2008, it was just plain dumb bad luck. Mm-hmm. But if you had cash back then you could have went, and that was one of the best buying opportunities of a generation.
Exactly.
When there was blood on the streets.
Exactly.
There was blood on the streets. So I bought, I think you told me that you bought Krispy Kreme during the 2000.
When I was in high school, yeah.
Yeah, so you bought Krispy Kreme. I bought Buffalo Wild Wings. My rationale for that was, well, people, no matter how bad the economy gets, people are still going to want to go watch sports and drink beer and have chicken wings with their friends and watch on the weekend maybe and watch some sports. And I figured, that type of, maybe they would cut back a little bit going out, but people would still want to do that. They would want to get out of the house and not feel sorry for themselves.
Yeah, no, I agree. The same thing with my rationale. I made a lot of money speculating in the biotech sector because it was just so beaten up in 2009, like crazy, how bad it was beaten up. But, rightfully so, that sector is a cheap money. It needs cheap money, low interest rates to survive because they don't make money. They're completely dependent on coming up with trials and new products, unless you're a scam like Valiant and everything, then it unfolds. But, I don't know if you feel the same way, but I think a lot of people, contrarian investing is clearly, it's the best approach to investing, in my opinion, because it is positively asymmetric. You can kind of get an idea of going against the crowd. And,
it's also the most difficult.
It is the most difficult. And the thing is, I feel like it's, some people, they say like, oh, how do you do this? Oh, I can't do this. One thing I learned getting older is, you can be educated as an Austrian. You can learn value investing and practice, but you kind of got to be born with that contrarian mindset. The mindset that when they hear like, a Ron Paul talk, it like a light bulb goes off, which is rare. It's not a lot of people out there doing this. But if everyone was doing it, though, there were contrarian opportunities wouldn't be available to us.
And value investors are getting killed now. Like, look at what happened with David Einhorn and Kyle Bass have not done well for a while. So value investing is not doing well. This is actually one of the worst times in recorded history for value investing.
Well, yeah, they fell for the old value traps.
Well, eventually, the thing is, people are paying people are desperate for yield because of what the central banks did. And then you have all these other central banks creating extra capital, and it's moving money into stocks, bonds, real estate. So what it would have been in the past, a normal cycle, those things are not. I speak with Eric Cinnamond in emails, he was actually ranked one of the top the top small cap value investor money manager on Wall Street for a while. And he's a hardcore value investor. He is in all cash, and he's been in all cash for years. He's waiting for everything to crash. He's waiting for the cycle to turn. So if you're a straight up bottom up hardcore value investor, I think he's had to do macro stuff, but he's not shorting a lot of stuff yet. And he's not long anything. He's waiting for a total bloodbath. But, because of what the central banks have done and how people are desperate for yields, we haven't had a normal cycle.
Yeah, no, that's true. Also, like with the Fed and everybody keeping everything afloat, and there's just so much money, like pension funds. They need like make 8% per year to meet their liabilities. But there's no way they're going to be able to make 8% per year on average for XYZ decades until their liabilities are due.
And those politicians, Adam, I don't know if you agree with me on this, but those politicians who made those promises to get the votes, those guys should be in prison.
Oh yeah, I mean it's like why I like the Austrian approach to it so much is that they see the politicians. It's not hard to rally up people who are not happy with things and tell them, hey, I can give you stuff. I can do this for you. Give me power. Vote me in. Give me a mob rule and I'll get it for you, So it's appealing to a lot of people. And I'm worried about when you see like Bernie Sanders and everybody running now, like, is that going to be the new normal? Is that we're going to, everything we don't like student debt or anything, or are they just going to print the money and bail it out? Like the modern monetary theory is like kind of trying to make a big comeback. I don't know why, probably because it sounds good to politicians, but in the real world, it just doesn't make sense.
Yeah, there's a lot of hypocrisy and double standards now. A lot of them are from like rich, hardcore Democrats who lost touch with reality. I mean, there's tons of technology entrepreneurs who have made lots of money and, they're promoting socialism and stuff like that now. I mean, there was, I don't know if you saw this. I know you're active on Twitter, but there was like Teen Vogue magazine in the last couple days, on their Twitter, they show all these expensive beauty products and makeup for women and stuff like that. But then they're just spending tons and tons of time. They have 3.4 million Twitter followers, right? Enormous Twitter following. And they spend all these articles promoting how great Karl Marx is, how capitalism needs to end to reduce poverty and all this stuff. So,
terrifying. It's like, do they not realize how horrible that is? Like how, you know what I mean? It's like no one has ever escaped a capitalist country running under barbed wires or from guns. Like you don't see free economies doing like those kind of things and having big bread lines and stuff. And it's crazy to me like how you can look at somewhere like Venezuela and all these other countries that are very terrible social what's it called?
Yep. Versions of collectivism or socialism.
Basically, it's I don't know. I to me, it's so baffling to me. It's like what I really like what Nassim Taleb says about this stuff is that people just depend too much on theory. Like all these academics say, oh, if everybody paid, like look at Sweden, They all do this. The thing is, with our tax system in America, we pay more taxes than anybody in the world, but we don't feel like we're getting anything back for it. You know what I mean? Like, at least in Sweden, the roads are really nice and paved. Everyone has free healthcare or cheap healthcare. The schooling's free, all those things. They feel like they're getting their money's worth. But in here, we're paying so much in taxes, and my roads are shoddy. There's I don't feel like I'm getting my money's worth.
You lived in Baltimore, so you know about like the 3 foot deep potholes and all the garbage there. And there's houses that are dilapidated from almost 100 years ago. Yes, yeah. Baltimore is like, but they have brand new traffic cameras and red light cameras and speed cameras everywhere, right? So. Yeah, so it's government misallocation of capital. It's very frustrating. I should have my friend Jose on a podcast. He actually escaped Venezuela, but
wow.
the socialism, yeah. So he writes for Mises and he escaped Venezuela. So that would be interesting perspective, but it's just very frustrating, all the socialist stuff that's going around online. So as we wrap up the interview here, Adem, you talked about trying to find low risk and high rewards, easier said than done. And if you really have to have, let's see, your discipline, you can't let your emotions rule you. You normally
an independent thinker.
Yes, and it normally takes a couple years to let it. Well, I think there is some luck involved, unless this brings me back to gold and silver as we wrap up the interview here. I think the best low risk, high reward are the royalty and streaming companies, because I believe gold and silver are manipulated, and that, okay, fine, they can keep the price down. The gold and silver companies are going to struggle. You know what? The regular mining companies will. That's fine. The royalty and streaming companies have cash. They have good balance sheets. They're not over leveraged. They're efficient. They have margins. So they'll just keep collecting cash and they'll just keep waiting while the rest of the industry is going to struggle. So I think that's low risk, high reward. There's 5 companies. I've named them on many interviews. So I think those guys are in the driver's seat. What do you think, though, about the rest of the gold and silver industry? Do you think that they can withstand much lower prices, or do you think 2 or 3 years from now, we're going to, maybe you think it's more than that, but do you think we're going to have to see higher prices?
Yeah, I do at this point. Because you have the big producers like the Barracks and the Gold Corps, they're going to be producing even if gold goes down, below 1,000. But it's those marginal producers that are just getting killed at these prices. They're barely breaking even. And like we were saying, in the peak gold production in 2015-16, it's ending at this point. The marginal producers can't. They're wasting their reserves. It's like what the uranium sector did. They kept thinking, well, we can keep, because a lot of people don't realize, but when the price of the commodity goes down, especially with oil, you see kind of before the capitulation, before they throw in the towel, supply ramps up. Because if you spend all this time building a gold mine and then the gold price drops, you say, okay, well, we can make up for the lost revenue of the lower prices with just producing more gold. But when everybody's thinking that in the aggregate, you have the price, a flooding, like a glut of supply coming on. It only until they realize we can't do this anymore. We got to put these mines on standby, or some go bankrupt. There were some big ones that went bankrupt. Allied Nevada Gold, that was a big one. That went bankrupt. You've had some big
New Gold.
New Gold.
They have. I don't think they've gone bankrupt yet, but New Gold is exactly what you described, right? They try to bring on Rainy River. They've had enormous production problems. I think they've been through a couple different CEOs. So there's and they have a bunch of debt to build the mine. So there's a bunch of red flags there. That company will probably go bankrupt or be restructured or something, or they will have to sell the assets for pennies on the dollar.
Yeah, exactly. Another thing that I think for people, management really matters in this sector, like the junior gold miners. You got to go with people you trust, because you can hear horror stories about people who've been burned by just, management who's lied and all these other stories. I've had it happen to me when I was younger, and it's definitely not fun. But there's a thing that people confuse causation with correlation. So when we saw gold prices rising from 2002 all the way up to 2012, anybody who had gold, you could have been the worst management at that point, but your company's assets were rising because the gold price kept going up. So a lot of bad managers who probably shouldn't have been in the industry to begin with, they looked like they were doing a good job because the asset they were sitting on was doing well. But then when the gold price fell, it weeds out those inefficient managers. And a lot of them can be smart. And I'm sure you'll agree with me on this. Just because you're a PhD in geology or metallurgy doesn't mean you're a good capital allocator. Doesn't mean you're a good CEO. So that's a lot of problems with a lot of the companies I see, is that they have people who are enamored by their project, but as an actual capital allocator and the business side of it, it's not economic. It doesn't make sense.
Exactly. There has to be a balance there.
Exactly.
And most companies struggle to maintain some type of balance.
Yes, true. So that's what I would tell people to be cautious with.
And also, I'm not sure if you've seen the research, but hedge fund manager John Paulson said that the gold mining industry destroyed over $80 billion in capital in the last decade. And there was another estimate from this private equity investor on Real Vision TV. I forget the guy's name. I mentioned it on a live stream a couple weeks ago. And this guy said $150 billion was wasted in misallocations of capital by the gold mining CEOs, while most of the gold mining CEOs kept paying themselves, very high salaries, stock options. So they made many millions of dollars for themselves. They destroyed tons of shareholder capital, and hardly any of them got fired.
Yeah, no, that's true. See, that's when the gold price is going up, people don't care. They don't look at those things. Like, we saw the same thing happen with oil. Oil to me was, like, me personally, one of my better shorting plays I've done. After oil from 2008 was over $100 a barrel until 2014. There were so many bad projects coming online. These fracking hit or miss. These projects that were only going to be good for 1 or 2 years, like 90% oil reserve deplete rates on those fracking spots, and every world country was pumping so much oil because the price was so high. You knew there was going to be a crash, and it just mind-boggled me. You'd see things like Chesapeake at record highs, piling on so much debt, people paying these high prices for them, when they were steaming towards barreling towards a brick wall. In that kind of position, it wouldn't be hard to just look at, while everybody's buying, look at the long dated puts on those things, especially because when it's such a high price, the puts are going to be way cheaper. When everybody liked Tesla up until recently, those puts you could have got for pennies on the dollar for long dated puts. Now it's it's ridiculously expensive. I mean, imagine if you were the one selling that to people back at such a high price.
Yeah, that's a way to make a lot of money in the markets, or to supplement some of your other longer term investments. You can trade around those. You can trade around some of those positions. But I think the Chesapeake Energy was also committing accounting fraud. So unfortunately, in this new financial engineering environment, also because the regulators aren't enforcing fraud, we don't really have a good rule of law right now, that a lot of publicly traded companies are committing accounting fraud. There was a presentation by Francine McKenna at the Jim Grant conference last week in New York City. Her slides are her slide presentation in the Wall Street for Main Street Facebook group, Adam. I don't know if you saw them yet, but she says in there that even Warren Buffett, Berkshire Hathaway now is committing accounting fraud. Oh. So it's a Alibaba, Berkshire Hathaway, there's a long list of companies now that are violating generally accepted accounting principles really, really egregiously. Yeah. And this is a new normal.
Yeah, it's all it takes is one of those big trusted names to get outed, and you could see the entire sector or industry shut down, with people, getting out, trying to, worried if there's going to be a kind of bank run per se. They don't want their company being the one, pulling off a big accounting fraud scheme.
Well, I think this problem, now that it's become systemic and pervasive, it wouldn't have been created in the first place if they actually enforced, fraud and the rule of law and actually threw CEOs in jail. So, it started before the 2008 financial crisis because there was problems before then. Obviously, there was Enron before then. So, the market, the regulators, the government is sending the wrong signal to these CEOs that basically, if you're a banker, only 2 guys are going to go to prison for rigging LIBOR, when, I'm sure most of the people in the bank knew that they were doing it. They've made Deutsche Bank and others made many billions of dollars in profit, and only 2 little lower guys who none of the CEOs or upper management really care about. They're the ones who are getting, busted for it.
Yeah, no, I agree. We're getting mixed signals from the government letting fraud run wild, and we're getting mixed signals from the Fed manipulating price signals. So, it's a mess both ways you look at it.
And this goes to Stanley Druckenmiller. The man has produced better investing returns than anyone over his entire career. And he was saying in his recent Real Vision TV interview that he can't fully understand what's going on with all the central banks. So this guy has more experience than pretty much anyone, a better long-term track record of making, profits trading and investing than anyone else. And if he can't figure it out, I mean, for people just getting started or who don't have a financial education and trying to, trade or make money, it's kind of blind luck then if they're making money.
No, it is. Yeah. Stanley Druckenmiller is one of the legends. He's someone I've looked up to over the years, especially because I'm more of a macro trader. And, I agree with him. It's just any way you look at it, it just doesn't seem like there's a good way out of anything. It just kind of seems, it's almost like the more you know about economics, the more depressing it is because you realize how bad the
Yeah, and then if you're a libertarian or an Austrian school, it's even more depressing because we're heading towards totalitarian government, more intervention, all the people talking about how good socialism is, despite its horrible track record in reality of all the people that have been killed and financially destroyed.
I'm a Austrian economist, I'd say by heart, but the one thing I got to say about it is they make a lot of great points, but the thing is, a lot of Austrians are like poor, people who, read a lot of books about Mises and stuff. That's why no one takes it seriously. I wish there'd be more Austrians who get rich using the theories, which there's tons of them. Like the Austrian Business School, business cycle theory is like a timeless theory you can use for governments with credit manipulation, artificially raising and lowering interest rates. It plays right into the financial instability hypothesis by Minsky. Like you can stack these theses that these brilliant men put together and make them your own. But I think one day, especially with our generation, as we get wealthier, there's going to be a comeback of Austrian economics because you're going to see a lot of people looking up to them like, hey, these people are rich. I care about what they say. You know what I mean? It's not just people blogging anti-government stuff.
Well, there's a ton of Austrian school and libertarian people who bought Bitcoin and other crypto, and some of them sold a lot of it a while ago at big profit. Some of them didn't sell, some of them didn't. But I think a common mistake, and I don't know if you highlighted this exactly, but I'm along those lines that you just talked about, is that a lot of people, and you said they're poor. I would say that most of them are not poor. Most of them have a good job or a small business or something, but they tend to, when they see all these things, the reality of the situation, they say, oh my God, everything's going to crash immediately. I have to put everything into gold and silver then.
Yeah, exactly. Like it's not practical.
Yeah. So that's the mistake, because I've talked about this at length, not sure how much of my other work you listen to, but we're in an environment now where the central banks and the politicians and the heads of corporations can lobby governments to get the rules changed. So if you put all your money into Bitcoin or crypto, you can get the rules changed and get screwed over. Look what happened, how Ethereum, the rules are changed on that for initial coin offerings, right? So the demand for Ethereum probably won't be as much. Look at, what governments can do with gold and silver. They can change the tax laws on it. So if gold goes to $10,000, right, the U.S. government could potentially, although gold doesn't have long-term capital gains taxes on, it's already taxed like a collectible. It's taxed horribly. Check out Dan Amerman's work on this. He has extensive articles on this showing the more government inflates, the higher the gold price goes. The way the U.S. government taxes it right now, gold, you would pay enormous tax bills on it. But the government could also come in and put an additional windfall profits tax. So this is a danger of the environment we're in, where the people in power, the economic and political elites, they can change the rules.
Yeah, I mean, and while you were talking, I just realized this. Like someone like a Rick Rule, like this guy has made so much money, booms and busts, great career, and he's a hardcore libertarian. He's always on liberty.me. He's on like the anarcho-capitalist websites. But how many main people in like the actual investing world know about him besides resource investors and or about Sprott in general, besides the resource things? Like we need more of those kind of people. The Bitcoins and stuff, showing the way for the new Austrians. Like you have like Ron Paul and like Rick Rule and them, like successful big name guys that could actually lay out rules, saying, hey, this is how I made my money. This is how I built my career, having these policies, like these fundamentals in my own life. That's what I would like to see more of.
Well, Adam, a lot of Wall Street people who are affluent know who Eric Sprott is, but they think he's crazy though, because they think he has Yeah, because he has too much exposure to mining stocks because as a value investor, mining stocks are bad businesses, right? So you don't want to hold a mining company long term because they can't generate free cash flow. But if you time the cycle right on these things, you can make a lot of money. But as a long term investment, buying in and holding these mining stocks, you don't want to do that.
No, definitely. It's very cyclical. You have to be active if you're going to be buying gold and silver stocks. If you want to buy like the physical metal, that's for like wealth preservation. The gold stocks, though, are for wealth creation. You know what I mean?
Yeah.
Yeah.
Yeah, and I consider physical metal also insurance. So, instead of
money.
life insurance or other types, or car insurance or other types of insurance, that's financial insurance.
Mm-hmm.
Because governments are, unfortunately, the dystopian reality, because I have a Welcome Dystopia podcast, which is supposed to be gallows humor, but the dystopian reality I see going forward is where most of these governments, Adam, are going to try to get away with more inflation and more taxes. And they're just going to try to layer it on, whether it's like you go out to eat and now you're paying a 10% restaurant tax, or, they're layering on more and more taxes across the board every year, every couple of years. Our listeners in California know about this with what they're paying for gasoline, and California's just turned into a crazy state.
Absolutely. Europe with gasoline is also crazy. I mean, there's really no real way out of it if you think about it. The next crisis, the Fed's going to lower interest rates. I wish... the only thing I could really say is I hope investors take more of a long-term view. I like to call it, when you play chess, you sacrifice a pawn, so it looks like you're losing in the short run, but you're actually positioning yourself for a win later. That's how I like to look at investing sometimes. Sometimes I'll sacrifice profits in the short run, or I'll buy gold and maybe my position will go down a little bit in the short run, but in a few months from now, the Fed is going to cut rates, or the Fed is going to be like, oh, the tightening's, clearly causing problems. Now that real rates are turning positive, we're already seeing the markets freak out recently. So then all of a sudden that gold will look smart 6 months from now. So I think people need to be a little bit more roundabout, which is stuff I've learned from like Mark Spitznagel, who's also a big Austrian investor.
Oh yeah, he has a superb book. I highly recommend it.
His new one's coming out soon too, Safe Havens.
Oh, really? Do you know him? Can you get me an interview on the podcast?
No, I wish. But he has a new book coming out, though, in a few months that I'm definitely going to look forward to reading.
I met Taleb in person at the Ron Paul Institute, but he didn't. I shook his hand and told him I liked his books, but he didn't seem very interested in wanting to come on a podcast. Yeah. Let's just put it that way.
Yeah. He's not a very sociable person from what I've learned.
Yeah, I kind of got the Socratic method there, where he kind of wants to piss every single person off that he ever meets. I kind of got that. He kind of reminded me of one of my law school professors who wanted to argue everything and piss everyone off that he talks to.
Right. Yeah. No, he's one of those people, but hate him or love him, he does have good ideas when it comes to risk management, in my opinion. Probably the best ideas in the industry. So, I mean, I appreciate his thoughts, but he's an acquired taste.
I completely agree. His books are good. I've read Fooled by Randomness, and I'm almost done with Skin in the Game. So as we wrap things up here, Adam, I've kept you over an hour. Thank you for your time. I think our listeners will find a lot of value in this content. If our listeners want to follow your work, how do they do so?
Oh yeah, just go to palisaderesearch.com. I publish on there a few times a week. We also do a weekly letter. You could sign up for free, and then you'll just get our emails once a week, or any research we're putting out on the junior gold mining stocks. And you can also follow me on Twitter at Radical Adem. That's Adem, ADEM. So a lot of people go ADAM. You won't find me on there. It's ADEM. And that's how you can find me. And I appreciate you taking the time to have me on. I hope we can do this more in the future.
Yeah, I really enjoyed this discussion, man. It was excellent. So hopefully our listeners think the same way as I do, at least in terms of that they got some value from the content.
Yeah, no, I definitely hope so too.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, If you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.